Thanks for staying with us on the news at 1. Let's take a look at your market news now. Asian markets recovered some of the losses suffered in a morning sell-off, but investors remained on edge ahead of a key Federal Reserve policy meeting. News of a massive data breach at Facebook fueled fears of a regulatory crackdown, and technology stocks therefore suffered in line with US stocks. In Japan, stocks closed in the red. The Nikkei share was down 0.5%. Hong Kong managed to eke out gains with the Hang Seng Index up 0.1%. Chinese stocks ended higher, led by gains in startup companies. The Shanghai Composite Index rose. Wall Street stocks dropped, weighed down by tech counters. Facebook in particular faced criticism over its potential misuse of user information. This saw other stocks like Amazon and Google suffer. Meanwhile, the Fed began its deliberations on monetary policy. Markets eagerly anticipate the Fed's interest rate decision out tomorrow. The Dow Jones Industrial Average fell 1.35%. The S&P 500 lost 1.42%, while the tech-heavy Nasdaq Composite Index declined by 1.8%. For more on the markets, we crossed to Nompumelelo Siziba at the Johannesburg Stock Exchange. Nompumelelo, we're seeing 5-week lows in the United States.
Yes, that's right. Those tech stocks came under some pressure, not only in the United States, but in Asia as well. And Facebook was the center of attention. It all started off with them supposedly having undermined clients' information or users' information. And so therefore, there was a concern that this would mean that the regulators would come down harder on tech firms. And this had a ripple effect right across on the likes of Amazon, Google, Facebook and so on. So that's what we saw, but we have to wait and see whether the regulators do intervene and what sort of impact that will have on the tech shares. Now, in the meantime, we do see that the rand has firmed slightly, this on the back of better than expected inflation, the headline number coming out at 4% in February year on year. That's very positive, and hopefully it means that the Reserve Bank will give us a bit of a break and cut interest rates come the end of the month. We have to wait and see. But on the converse, we did get some data out from the Reserve Bank. Our current account deficit, it widened more than expected to 2.9% of GDP. And this was on the back of the trade surplus narrowing slightly. And that was due to the fact that the rand had appreciated. So because the rand had appreciated, it made imports more affordable. So we ended up importing more than we were exporting. And so therefore, that trade surplus narrowed somewhat. So anyway, the other issue that I've neglected to mention, the all-share index. The all-share index is in positive territory at the moment. Let's take a quick look at the indicators. I'm joined by Rikus Readers. He's from PSG. Thanks for joining us, sir.
Hi there, how are you doing?
Good stuff. Now, markets obviously globally concerned about what the US Fed is going to come out with tomorrow. The expectation is that there will be a hike. Your thoughts on markets in general?
I think markets are waiting for that. Not totally unexpected. Most analysts in the US expect, apart from tomorrow, 3 more rate hikes going into December. I think that's put a bit of softness into equity markets, and it's also led to a bit of a increase in the value of the dollar when you measure it not only against us but to quite a number of other currencies. So it's just shifted the balance somewhat.
All right. And then in terms of the rand, we see that even though it's improved slightly, maybe on the back of data, maybe not, we've seen it strengthen very slightly, so it's below 12 against dollar. Yeah. But we have seen a general weakness. Do you think that has something to do with the positivity on the all-share index?
Possibly. I think most of the rand strength, as I've said, is because of, rand weakness, is because of the dollar going up, and that's been going on since about the last quarter of February. So the day-to-day weakness, strength, who knows? Maybe it's just because there's a 12 rand psychological level, as they call it, that is trying to go through. But obviously the inflation numbers helped, maybe the trade figures not so much. So it's all on balance at the moment.
Now, that inflation number for February, consumer price inflation coming in at 4% year on year, that's a fantastic number. Should we get excited? Maybe the Reserve Bank will be nice to us next week. Surely they should cut rates.
They certainly have a lot more incentive. I think if one takes a look at the poll of local economists, they all expect that a rate cut might in the offing. There's certainly no reason for them to increase rate. Maybe they'll be a bit more cautious, but certainly the kind of inflation figure we saw this morning adds to the argument that we can afford a rate cut.
Now, even though the current account deficit was wider than expectation, it's still below that key 3% mark. So what's your view on that? Would that have been rand negative, or it's really negligible?
Again, it's the trend that matters. So if we see further strengthening in the rand, obviously that's going to be pretty good if you're an importer. So all of a sudden your import figures are going to start surprising on the upside, which could be negative. In other words, that could then again, all these things are connected. Then one's got to take a look at our interest rates, whether or should one leave it at that. But yeah, I think the rand has certainly surprised, going stronger for quite a considerable time now, and that kind of thing might continue.
Now, there's been a lot of excitement in the local equity space for South African equities. We've seen a lot of foreign investment coming into South African equities for at least the last 3 months or so.
Yes.
And of course, the big question mark is, will this continue? How will Moody's rate us later in the week, and so on? But the elephant in the room, some marginal voices are saying, is the expropriation without compensation issue around land. How much of a factor do you think that is in possibly dissolving the enthusiasm that South Africa is enjoying right now?
I won't go as far as say dissolving it, but certainly in the first three months there was a lot of exuberance, if I can use that word, because there's a new political environment that we find ourselves in. It will always have a reality check coming from somewhere. In this case, it's land, and land's important. I mean, it's one of your 4 production factors. Obviously, it has a huge effect, and it's not the fear of because you know what's going to happen. It's the fear because we don't know what is going to happen. So I think it's not a bad thing to have a reality check every now and again, because let's face it, we had a huge run in some sectors. I'm thinking about financial specifically, up until when this question was asked about land. So maybe it's just a bit of reality check, and let's just see where we are. Let's not count on chickens before they're hatched, either on the positive or on the negative side.
Okay, fair enough. Very lastly and quickly, Tiger Brands, they've been in the papers and the news for all the wrong reasons.
Yeah.
Are they, despite everything, would you still invest in them?
I think the question there is what we know thus far and what we don't know. What we know thus far, according to the company, is that they're looking at about R1 billion problem that they've got. We don't know how much bigger this is going to get. So in that sense, you can't quantify it. And even if you believe that a year, 2 years, 3 years from now, whenever, it will work out of Tiger Brands' system, in the meantime, I'm quite sure you can have a better opportunity somewhere else.
All right, we're going to leave it there. Thank you so much for your time. As always, Rika Sreeders, Portfolio Manager at PSG. After a short break, in Zinga with more business news for you.